This is the Simplify U.S. Equity Plus Managed Futures Strategy ETF, ticker symbol CTAP. In this video, we'll discuss what is CTAP, how CTAP is managed, and portfolio use cases. CTAP seeks long-term capital appreciation by combining exposure to equities with a managed futures strategy. It combines 100% exposure to large-cap U.S. stocks with 100% exposure to a managed futures strategy, giving a total of 200% notional exposure. The stock exposure is gained primarily through shares in a low-cost liquid ETF. A small amount of equity futures is used to obtain the required amount of leverage. The managed futures exposure is based on the Simplify Managed Futures Strategy ETF, ticker symbol CTA. CTA takes long and short exposures in commodities and interest rate futures. It selects from a universe of over 50 global futures contracts. Most importantly, it has a history of having extremely low correlations with both stocks and bonds. Exposure to CTA is via total return swaps. Total return swaps are a derivative instrument tied to the performance of an underlying asset, in this case CTA. It is an efficient way to obtain the required exposure to CTA. We're not going to go in-depth on CTA in this video. Investors can visit the Simplified website, where the CTA page provides a wealth of information on the fund, including multiple videos that do a deep dive into the strategy. The most important question is, what are the use cases for CTAP? 3 reasons to invest include to increase portfolio diversification, to help reduce line item risk, and to increase capital efficiency. Let's start with diversification. The most important diversification metric is correlation. The SGCTA index, an index that measures the performance of a basket of leading managed futures strategies, has historically had about 0 correlation with stocks and bonds. At a time when stocks and bonds have had growing correlations with each other, an asset with 0 correlation to either can provide some meaningful diversification benefits. More importantly, managed futures have historically performed at their best when stocks are performing at their worst. During severe stock market declines, including the dot-com bust of the early 2000s, the global financial crisis, and 2022's inflationary bear market, managed futures have had significant positive returns. Reducing line item risk is another benefit of combining managed futures with stocks. During stock market declines, managed futures might delight the client, for example, during the global financial crisis. However, during big stock market rallies, which occur more often than declines, the client is likely to point to the line item in their portfolio that displeases them the most, which could be the managed futures position. What if we combine 100% exposure to stocks with 100% in managed futures? Taking us back to the episode when investors hated their managed futures position, the combination provides a return somewhere in between, making the exposure to managed futures much more palatable. Ultimately, the combination seeks to smooth returns, attempting to make it easier for investors to buy and hold managed futures and thus benefit from owning them over time. The last use case for CTAP is the potential for capital efficiency. Suppose an investor starts with $60 in stocks and $40 in bonds for a combined $100 investment. If they were to swap some of their stocks with CTAP, for example, $30, they could maintain their exact same $60 stock and $40 bond allocation. However, they would gain an additional $30 in managed futures with no additional capital outlay. Another way to look at the power of capital efficiency is to take a look at the 100% stocks plus 100% managed futures combination versus a 100% stock position. Since 2007, this combination significantly outperformed the 100% stock allocation. More importantly, it would have outperformed during severe stock market declines. Now for some Q&A. Will CTAP be less volatile than a 100% equity investment? No. Even with the diversification benefits of managed futures, the 200% gross exposure will likely mean CTAP will have a higher volatility than a 100% equity fund. However, historically, adding managed futures would have reduced portfolio drawdowns in severe equity bear markets. When would it make sense to invest in CTA directly instead of through CTAP? There are two use cases for investing directly in CTA. When the investor does not want to gross up their portfolio exposure over 100%, or when the investor does not want any exposure to large-cap U.S. stocks. CTAP appears to have a much lower expense ratio than CTA. How is this possible? The stated expense ratio for CTAP is significantly lower than CTA. However, the swap is based on the total return of CTA net of fees. Therefore, the all-in cost of owning CTAP is effectively higher than it is for CTA, even if the published expense ratio is lower. Thank you for viewing this presentation. For more information about CTAP or any other Simplify ETF, please go to simplify.us/ETFs. We'd like to hear from you directly, so if you click the Contact Us link at the top of the page, you can get in touch with us and we'll respond promptly.